Okay, so now let us basically see what do you mean by salaries. This definition of salaries is given under section 17 and it is an inclusive definition. You all must be knowing what is the meaning of inclusive and exclusive definition. Okay, but at the sake of repetition, I'll just explain it to you again. So section 17 says that salary includes. Now what does this mean? That salary also includes certain other things, but specifically all these are forming part of the salaries. So anything else beyond this which an employer gives to an employee, again I'm laying stress on the fact that it has to be given by the employer to the employee, is also salary, but these specific things are included. The first one is wages. Now wages and salary is basically one and the same thing. The only difference that is there is that while salaries are normally payable on a monthly basis, wages could be daily, weekly or monthly. That's basically predominant difference between these two. Beyond that, wages are also something similar to salary only. The second thing is annuity or pension. Now this requires certain more deliberation. Let us see. What happens is that an annuity is something like, a annual kind of a payment which is made over a predefined period of time. When we say annuity for the purpose of salaries, this means an annuity paid by the employer. Now this employer could be present employer or it could be a former employer. In both these cases, it's taxed under the head income from salaries. The only difference is while that this received from the employer is taxable as salary, annuity received from a former employer is taxed as profits in lieu of salary. Please note there is no difference between these two, but both are taxed under the head salaries only. But the nomenclature is different, and what do you mean by these two is something which I am going to explain to you as we move on in our lectures. So a salary or a profits in lieu of salary depends on whether it is paid by the present employer or the former employer. If it is paid by someone else and not the employer, then it is not taxable under the head income from salaries. So say an annuity paid by a life insurance or an insurer to a person is not taxable under the head salaries. Please note all these down in your notes because you may not have a hard copy of this, but these notes you can please take down. So what happens is that any annuity received from a non-insurer is not taxable under the head salaries, or sorry, a non-employer. Or pension. The next one which we saw was pensions. Now your question might be, what do you mean by pension? What happens is normally once an employee resigns from the services, say suppose someone worked till the age of 58 and thereafter he retires, in order to show a sign of gratitude towards that person who served the company for a long time, companies give pension, which means maybe not the entire salary but a percentage of their salary till a particular point in time or till they are alive. So that is which is received from an employer. So again, the employer, if he pays any pension to the employee, it is taxed under the head income from salaries. And we are going to see all these in details as we move on. Each one of these items has been discussed independently in the subsequent slides. Gratuity. Again, what do you mean by gratuity? Gratuity is a lump sum amount paid by the employer to the employee after he completes a minimum period of service, which is normally 5 years. There's a Payment of Gratuity Act which you would have studied as a part of your mercantile law paper. This is the same gratuity. to be discussed in detail in the subsequent slides. Any fees, commission, perquisite, or profits in lieu of or in addition to any salary or wages. So what happens if the employer, instead of paying me in cash, gives me certain perquisites, certain benefits? Then that also is taxable under the head income from salaries. The next one is, and again, as I said, not at the cost of repetition, to be discussed in subsequent slides. Employer's contribution to a recognized provident fund in excess of 12.5% of salary and interest in excess of 9.5% per annum. So if the employer contributes under the Provident Fund Act, an employer is under an obligation to contribute certain percentage of the salary of the employee to a provident fund. But if the employer contributes more than 12.5% of the salary, then that is also taxable. Leave encashment, transferred balance of a recognized provident fund of an employee, again to be discussed in detail, and central government contribution to employees under a pension scheme referred to in section 80CC(d). So all these we will be discussing in detail as we move on to our next slides. As of now, please note that all these fall within the definition of salaries. Wherever they are paid by the employer or a former employer, or they are paid on behalf of the employer, these will be included in the salary when we compute the total taxation.